Good evening, everyone. Mike over at Charts Don't Lie. I wanted to put this video together for you guys over the weekend, but with the action that I'm seeing here in the market currently, I figured I probably should get this out to you guys this evening. So up on the screen, you'll see we have a chart of the S&P. Now, I had mentioned about a week ago that I was looking for an opportunity to short the market. Many people thought that was crazy with the market at all-time highs and this Santa Claus rally coming up. Well, when everybody is talking about something, that always makes my ears perk up and look for something else to happen. With everybody talking about this Santa Claus rally and how we're going to go into the end of the year off at the highs, it makes me think it's not going to happen. When I look at the charts, it becomes really apparent that there's a high probability that that won't happen. I talked about the bearish RSI divergence across all of the major indices. I'm just going to take a look right now at the S&P itself. The reason why I got bearish, we have this RSI divergence. More importantly, we're in this prolonged uptrend and we haven't had a 10% correction, which is unnormal. And we're banging into this rising resistance. And you can see it on the daily. You know, every time that we've kind of run into this, sometimes we just continue to grind a little bit higher, but we always have some sort of a pullback from that. And, you know, you look on a weekly chart, my target is going to be this lower end of the rising channel. Touched it once, twice, 3, 4 times. That's a pretty good target. That would put us at about 1980 on the S&P futures, or 198 on the SPY, which isn't too far to fall. It's another 3%. Now, with that in mind, we took shorts on in the beginning of this week when I started to see some weakness and I started to see an uptick in volatility. That kind of gave me a look that the market might head a little bit lower. Now, I'm not calling for a crash here by any stretch of the imagination. And in fact, we covered our shorts yesterday. The reason we covered our shorts yesterday was we like to play when we're trading for high probability occurrences, not the low probability occurrence. So when we go from the upper Bollinger Band and we're headed lower, where's the likely target? The lower Bollinger Band. It's going to stay in the it's going to stay in the Bollinger Band 95% of the time. It's going to be outside of it 5% of the time. So I'm going to bet on the 95% thing, and we went ahead and we took the SPXS, which is the 3x inverse of the S&P, off the table yesterday. Now, from what's going on underneath the surface, and I'll get to that in a second, I still have a bearish thesis going on in the market. So what I was looking for was a bounce today that wouldn't make a higher high so that I could re-put my shorts back on, and that's exactly what I got. Now I'm going to zoom into a 15-minute time period right now, and you can see here we have made lower highs and lower lows. That is a bearish trend that we've got going on. So what I was watching today was, could we get back over this resistance right here, and would we go ahead and make a higher high? The answer to me became clear looking at a 15-minute chart when I got what looked like a rising wedge setup, and it broke underneath. So we added SPXS here, and we also added UVXY at the same time, and the market turned over. Now, I've been looking at volatility for a long time, and as you can see, speaking about lower Bollinger Band, this has been a really good support for about 6 months in the VIX, and it came down, it touched its lower Bollinger Band, and it shot back up again. So that's why we picked up UVXY. Now, when we take a look at the overall trend in the market, it's obviously still higher. We can't call for a breakdown or anything large. All we're calling for is just a simple test of that lower support that's been rising for years in the S&P. Now, what I wanted to do is I wanted to look a little bit deeper underneath the surface and really get an understanding of what's going on, because to me, it feels like risk is really leaving this market. And the reason being, you can see very clearly when we start looking at things like high-yield corporate bonds, all right? This continues to make lower lows. I mean, very strong. And junk bonds as well. This is a sign that people are taking risk off of the table. Speaking of risk coming off of the table, we had an interesting occurrence the other day in the junior miners. After I put the video out the other night in terms of gold and silver, gold actually went up, but the junior miners went down. Now, why would that happen? Well, junior miners are certainly an area of high risk. And what I have on this chart is actually the junior miners against the S&P intraday yesterday while the market was falling. And what you can see is JNUG was not actually tracking gold anymore. It was tracking the S&P. And what that was telling me is people were selling risk, and they were looking at miners as risk. So as the S&P went down, people were also selling off the junior miners, even though gold itself was rising. Now, when we take a look at junk and corporate bonds, once again, they're rolling lower. But even when we take a look at like the Russell, where people like to put higher amounts of risk when they think the market is going higher, it's done nothing for the entire year. It's flat, which means, you know, people are not willing to take on that higher amount of risk. The micro caps are even worse. They're actually negative for the year. I think now today they finished down somewhere about 2-3% for the entire year. It's a good sign that people are not taking risk in the market. It's coming out, and that typically tends to catch up to the overall market, which is why we're starting to see the S&P and the Dow start to kind of roll over. Now, this all has to do with crude oil, right? And as we can see on this is a 30-minute chart on crude. It's done nothing but go basically straight down in a 45-degree angle since 75. We're actually now under $59 a barrel. I don't think the market is priced in what cheap oil is really going to do to the economy. I continue to hear, once again, one of those things that perks my ears up is when everybody's singing the same tune. Well, great. Cheaper oil means when I go to the gas station, it's going to cost me less to fill up with gas. I'm going to have an extra $20, $40 a week in my pocket. I'm going to go out in the economy. I'm going to spend it, and it's going to grow the economy. In reality, what's going to happen is if we stay at this $50, $60 in oil range, a lot of the oil companies are going to go out of business, or they're going to be picked up for pennies on the dollar, and employees are going to be laid off by larger oil companies. You know, we're the largest energy producer, and you know, most of these companies have $70, $80, $90 a barrel costs in order to break even. So at $50, $60 a barrel, they're losing money. Lots of banks have made loans to oil companies, and they've gone out and explored and spent it on machines and operations, etc. If this oil stays down here, continues to go lower, or even stays where it is right now, they're not going to be able to pay those loans back. They're going to lay people off, and that in turn is going to have more negative consequences. You know, if Bob gets laid off, he's not going to be able to make his mortgage payment. He's not going to be able to go out to the restaurant. The restaurant owner is going to have issues, et cetera, et cetera, et cetera. So I really don't think the market is priced in the risk that this low oil has brought on. And what I want to do is give you another comparison of high yield corporate paper against the S&P. And what you'll see is in 2007, the market was rising while high yield corporate paper was rolling over. And we all know how that went. Well, here we are again. The market is rising while high yield paper is rolling over. Strong correlation between these two. High yield typically tends to lead. What's going to happen here? Well, either high yield corporate paper is going to go back up, or the market's probably going to come back down. It's the same type of look at junk bonds and crude. Cheap oil is not good for an oil-based economy. And we can go back and we can take a look at how crude tracks against the S&P. They followed very, very closely. The one time they sort of didn't was during the initial stage of the collapse in 2008. Oil went up, the market went down, and we saw exactly what happened there. Oil ended up following it. Well, right now the market's going up. Oil is continuing to crumble. What's going to happen here? Is the market going to follow it, or is oil going to bounce back up and match the market? With everything put it all together, it looks like we have a recipe for a number of reasons for the market to head lower. I'm not by any means trying to call a top or a large crash or anything like that. All I'm saying is right now, with where we are, banking into this rising resistance with risk coming out of the market, it makes sense to be short. And it makes sense to be short down to, like I said, about 198 in the S&P, and then to reevaluate. So I wish you all the best. I wanted to share this with you just so you guys were aware of what's going on underneath the surface, because on top, the markets look okay, but underneath really, really, really looks about as bearish and as scary as I've seen it in a very long time. So just be cognizant, protect yourself. Remember, put stops in. My stop's back at the high of the day today for the S&P. If the market rolls, heads back up and takes that out, okay, I'll look to go long again. Have a good evening, everyone.